What if January 2026 becomes one of those moments investors talk about years later, the month when money quietly rotated and only prepared investors benefited? While headlines focus on noise, the real opportunity is forming underneath the market, and most portfolios are not positioned for it. Here's the truth few are saying out loud. The U.S. market entering 2026 is not driven by hype, it's driven by capital discipline, earnings quality, and pricing power. Rate cuts are being anticipated, not celebrated. Inflation hasn't disappeared, it is stabilized. And institutional money? It's rotating early, before retail even notices. That's why January 2026 matters. This is the window when long-term investors, especially intermediate and older investors, quietly reposition into high-conviction stocks that can outperform through volatility, not just survive it. These are businesses with real cash flow, structural tailwinds, and balance sheets designed for uncertainty. Before we reveal the first stock, you need to understand the playbook being used right now. Smart money is not chasing speculative rallies, it's moving into companies that benefit from three forces converging in 2026. Slower but stable economic growth, gradual monetary easing, and explosive demand for productivity and infrastructure efficiency. That combination favors cash-generating leaders, not flashy stories. Stock number 1, Microsoft, the quiet backbone of the 2026 economy. Microsoft is not exciting, and that's exactly why it's dangerous to ignore. In January 2026, Microsoft sits at the intersection of AI monetization, enterprise dependency, and recurring revenue dominance. While other tech companies are still proving concepts, Microsoft is already collecting checks. Here's what makes MSFT a buy now candidate, not a wait-and-see stock. First, Microsoft's AI strategy is embedded, not experimental. Azure AI services, Copilot integrations, and enterprise automation are no longer optional upgrades. They're becoming standard operating tools for businesses trying to cut costs and boost productivity in a tighter economic environment. When CFOs feel pressure, they don't cancel Microsoft, they consolidate into it. Second, Microsoft's revenue mix is defensive and offensive at the same time. Cloud subscriptions, enterprise software licensing, cybersecurity services, and productivity tools create predictable cash flow, while AI-driven upsells expand margins quietly in the background. That's why institutions love this stock during transition periods. Third, dividend growth matters in 2026 than it did in 2021. Older and intermediate investors are prioritizing income stability plus upside, and Microsoft fits perfectly. Strong free cash flow allows consistent buybacks and dividend increases, even if markets stall. Now look at valuation context. Microsoft isn't cheap, but it's reasonably priced relative to earnings durability. In uncertain markets, investors overpay for reliability, and Microsoft has become one of the most reliable earnings engines in the U.S. market. This isn't about doubling your money overnight. This is about capital preservation with asymmetric upside, the foundation of a serious portfolio. Why January 2026 matters. Historically, January repositioning favors megacap leaders after tax loss harvesting resets portfolios. Institutions deploy capital early in the year into names they plan to hold through volatility. Microsoft is consistently one of those allocations. Missing this phase doesn't just mean missing gains, it means being forced to buy later at higher prices when momentum investors catch on. Microsoft provides the foundation, but foundations alone don't outperform. In the next part, we move into a stock position to benefit directly from U.S. infrastructure spending, AI energy demand, and federal capital flows, a name most retail investors are completely underestimating right now.
Every major market cycle has a phase where money moves before the headlines appear. In 2026, that movement is already happening, and it's flowing into one critical area most retail investors underestimate: U.S. power infrastructure. AI doesn't run on optimism, it runs on electricity, and the demand curve in 2026 is bending sharply upward. That brings us to stock number 2, a company positioned at the center of energy demand, grid modernization, and long-term federal-backed spending. Stock number 2, NextEra Energy, the AI power play hidden in plain sight. NextEra Energy is not a hype stock. It doesn't trend on social media, and that's precisely why institutional money loves it right now. NextEra is the largest producer of renewable energy in the United States, but framing it as just a clean energy company misses the bigger picture. In 2026, NextEra is becoming a critical infrastructure provider for data centers, AI clusters, and high-density computing facilities. Here's why this matters. AI workloads are exploding, and data centers are consuming power at levels the U.S. grid was never designed to handle. Hyperscalers don't just need energy, they need stable, long-term, scalable power contracts. That's where NextEra dominates. Through long-term power purchase agreements, regulated utility operations, and grid-scale renewable assets, NextEra provides predictable revenue streams that grow quietly year after year. This is exactly the kind of business model institutions favor when volatility remains elevated. The 2026 tailwinds working in NextEra's favor. First, federal and state infrastructure alignment. Energy grid upgrades, renewable incentives, and transmission investments are not political talking points anymore. They're funded initiatives already in motion. That translates into visibility, not speculation. Second, interest rate sensitivity is improving. Utilities were pressured when rates rose aggressively. As 2026 brings expectations of easing or stabilization, capital-intensive businesses like NextEra regain valuation support. That shift alone can re-rate the stock without explosive growth. Third, dividend reliability. For intermediate and older investors, income consistency matters. NextEra has a track record of dividend growth supported by regulated cash flows. In uncertain markets, yield stability becomes a psychological anchor for portfolios. But here's the overlooked angle. NextEra isn't just defensive, it's strategically offensive. The company is positioned to benefit from AI expansion without competing in the crowded tech space. You're not betting on software adoption or consumer behavior. You're investing in energy demand that must exist. That's a powerful asymmetry. Why January 2026 is a smart accumulation window? Historically, utility and infrastructure stocks outperform when investors rotate from growth at any price into earnings certainty. January is when institutional portfolios rebalance towards stability after volatile Q4s. Waiting for perfect clarity usually means buying later, after yields compress and valuations expand. NextEra fits a specific role: portfolio stabilizer, inflation hedge through regulated pricing, AI-adjacent growth without tech volatility. Ignoring this category exposes portfolios to a hidden risk: owning AI beneficiaries without owning the infrastructure that powers them. So, now you have a foundation stock and an infrastructure anchor. But every high-performing portfolio needs one more element: a company positioned to benefit directly from consumer behavior shifts, pricing power, and recession-resistant demand. In the next part, we uncover stock number 3, the most underestimated opportunity of the three, and the one that could surprise investors the most in 2026. When markets feel uncertain, investors make one critical mistake: they underestimate human behavior. Technology changes, rates fluctuate, headlines rotate, but people don't stop buying necessities, and they don't abandon brands they trust. That behavioral constant is exactly what makes stock number 3 so powerful heading into 2026. This is not a flashy momentum trade, it's a pricing power machine, a company designed to perform whether the economy accelerates or slows. Stock number 3, Costco. Pricing power meets consumer loyalty. Costco doesn't depend on hype, it depends on membership psychology, and that model becomes more valuable when consumers grow cautious. In January 2026, Costco stands out as one of the strongest consumer-facing businesses in America because it benefits from both inflation control and consumer defensiveness. Here's why institutional investors quietly accumulate Costco during uncertain cycles. First, Costco's membership revenue is predictable and recurring. Annual fees generate high-margin income before a single product is sold. That creates a financial cushion most retailers don't have. Second, Costco thrives when consumers try to save money. During inflationary or high-cost environments, shoppers trade down from premium retailers into bulk buying and value-focused stores. Costco captures that shift without discounting its brand. This is critical. Costco protects margins while competitors fight price wars. Third, pricing power. Costco can raise membership fees selectively without meaningful churn. That ability acts like an invisible lever on earnings. Even small fee increases ripple across millions of loyal members, lifting profits quietly and consistently. Now layer in demographics. Older and intermediate investors often overlook how aligned Costco is with their own spending habits. Retirees and families alike rely on Costco for essentials, healthcare items, food, and household goods. That demand doesn't vanish during downturns, it becomes more concentrated. Why Costco matters in a 2026 portfolio? 2026 is shaping up as a year of selective consumer spending, not broad-based exuberance. In those environments, companies with trusted brands and cost advantages outperform discretionary peers. Costco isn't immune to market pullbacks, but historically it recovers faster and falls less during corrections. That downside protection is valuable when capital preservation matters as much as growth. Another overlooked angle is wage pressure. Retailers struggle with labor costs, but Costco's higher wages reduce turnover and increase efficiency. Lower churn leads to better customer experience, reinforcing the membership model. That flywheel compounds over time. This is how long-term wealth is built, through systems, not speculation. From a valuation standpoint, Costco often looks expensive, but investors repeatedly learn the same lesson: you pay a premium for predictability. In uncertain markets, predictability outperforms hope. How these three stocks work together? At this point, the pattern should be clear. Microsoft anchors growth and innovation. NextEra stabilizes income and infrastructure exposure. Costco protects purchasing power and consumer demand. This isn't about chasing the next hot trade. It's about constructing a resilient 2026 portfolio designed to weather volatility while compounding steadily. Most investors fail not because they pick bad stocks, but because they lack balance. In the next part, we step back and answer the most important question: how to allocate, manage risk, and avoid the biggest mistakes investors make when buying these stocks in 2026. This is where strategy turns into execution.
Buying the right stocks is only half the game. Most investor losses don't come from bad picks, they come from bad positioning. January 2026 is not the time to gamble allocations, it's the time to structure them. This part is where many investors finally separate themselves from emotional decision-making. Let's talk execution. Step 1. Understand the role of each stock. Each stock you've seen so far serves a specific portfolio function. Microsoft is your growth engine. NextEra Energy is your stability and income anchor. Costco is your defensive consumer compounder. Treating them equally without understanding their role creates imbalance. Smart investors don't ask which stock will go up the most, they ask which stock protects me when I'm wrong. Step 2. Sample allocation framework, not financial advice. For a balanced January 2026 approach favored by institutions, Microsoft, 40%. This reflects its earnings durability, AI-driven upside, and long-term compounding power. NextEra Energy, 30%, provides income stability, infrastructure exposure, and rate sensitivity recovery potential. Costco, 30%, balances consumer resilience, pricing power, and downside protection. This structure allows participation in growth while minimizing portfolio stress during pullbacks. Older investors may tilt slightly more towards Next Era and Costco, while intermediate investors may favor Microsoft for longer horizons. Step 3. Entry strategy. Avoid the biggest January mistake. Most common January error is lump sum emotional buying. Instead, experienced investors use staggered entries. Divide your intended position into 2 to 3 tranches. Enter on mild pullbacks or consolidation days. Avoid chasing green candles. This reduces regret and improves long-term positioning. Remember, great companies often go sideways before they go higher. Step 4. Risk management rules you must follow. No stock is risk-free. Ignoring risk doesn't eliminate it, it magnifies it. Key principles for 2026. Never allow a single stock to exceed 10 to 15% of your total portfolio. Rebalance quarterly, not weekly. Focus on earnings trends, not daily headlines. If Microsoft's growth slows, Next Era and Costco act as shock absorbers. That's intentional design. Step 5. What not to do in 2026. Avoid these traps. Overtrading based on news cycles, chasing speculative AI names without cash flow, panic selling during routine corrections. Markets in 2026 will likely remain volatile but range-bound at times. Those who overreact will underperform. The winners will be patient, structured, and disciplined. Why this matters more than ever? Investors who fail to plan allocations often abandon good stocks at the worst time. This is especially dangerous for older investors relying on capital stability. The goal isn't excitement, it's longevity. Now that you understand allocation and execution, there's one final piece most investors ignore: the hidden risks and warning signals to monitor in 2026 so you can protect gains before others react. That's exactly what we cover next.
Markets rarely collapse without warning. They whisper first. The problem is, most investors don't know what to listen for. In 2026, the difference between protecting gains and giving them back will come down to signal recognition, not prediction. This part is about knowing when to hold, when to rebalance, and when to stay calm while others panic. Signal number 1. Earnings quality over earnings headlines. Headline earnings beats can be misleading. In 2026, smart investors will focus on earnings quality, not surprises. For Microsoft, this means watching cloud revenue growth consistency, enterprise contract renewals, AI services margin expansion. If revenue grows but margins shrink, that's a yellow flag, not a red one, but worth monitoring. For Costco, pay attention to membership renewal rates, traffic growth during economic slowdowns, and gross margin stability. Costco losing traffic would matter more than missing earnings by a few cents. Signal number 2. Interest rate direction, not timing. Trying to predict rate cuts is a losing game. Instead, watch the directional bias. Next Era benefits from stable or declining long-term rates. Rising volatility in bond yields, especially the 10-year Treasury, can temporarily pressure utilities even if fundamentals remain strong. That doesn't mean sell, it means expect noise. Understanding this prevents emotional exits. Signal number 3. Capital rotation, not market crashes. 2026 is more likely to deliver rotations, not crashes. Money may rotate from high-growth tech into infrastructure, from speculative AI into cash flow leaders, from momentum trades into dividend stability. If Microsoft underperforms for a quarter while Next Era or Costco leads, that's not failure, it's balance working. Investors who chase performance often destroy it. Signal number 4. Consumer stress indicators. Costco acts as an early warning system. Watch average basket size, private label product growth, membership upgrades or downgrades. Rising private label demand often signals consumer stress, but for Costco, that can actually boost loyalty. This nuance matters. The biggest risk most investors ignore. The greatest danger in 2026 isn't a recession, it's behavioral risk. selling strong companies too early, overreacting to social media narratives, confusing volatility with failure. Professional investors expect drawdowns. Retail investors fear them. Your advantage is patience. Final portfolio reality check. If you own companies with strong cash flow, pricing power, and structural demand, then time is working for you, not against you. Now that you've seen the stocks, the strategy, the allocation, and the risk signals, it's time to put everything together. In the final part, we lock in the mindset, the execution plan, and the exact reason ignoring this setup could cost investors years of opportunity.
Most investors don't lose money because they choose the wrong stocks. They lose because they hesitate, overthink, or wait for certainty that never comes. January 2026 is not about predicting the future. It's about positioning before the future becomes obvious. And by the time it feels obvious, the opportunity is usually gone. The reality of the 2026 market environment. 2026 is shaping up to reward discipline over excitement. Slower economic growth, selective rate relief, heavy capital rotation, and AI maturing from hype to monetization. This is not a lottery market, it's a wealth-building market. And wealth-building markets favor investors who think in systems, not emotions. That's exactly why the 3 stocks covered in this video matter together, not individually. The complete 2026 framework you now have. Let's lock it in clearly. Microsoft gives you exposure to AI monetization, enterprise dependency, and long-term earnings compounding. NextEra Energy gives you exposure to AI power demand, infrastructure spending, rate stabilization, and dividend growth. Costco gives you exposure to consumer resilience, pricing power, and membership-driven cash flow. Together, they form a portfolio built for uncertainty, not perfection. This is how institutions think. The cost of doing nothing. Here's the uncomfortable truth. Investors who sit in cash too long don't avoid risk, they lock in opportunity loss. Inflation doesn't stop quietly. Purchasing power erodes slowly, then suddenly, and by the time confidence returns, prices have already moved. January 2026 is a positioning month. Waiting for confirmation often means buying after rallies, not before them. How smart investors will execute from here. They'll enter methodically, not emotionally. They'll rebalance, not panic. They'll hold through noise, not headlines. They understand that volatility is the price of admission, not a warning sign. This mindset shift alone puts you ahead of most market participants. Final thought. The market doesn't reward intelligence, it rewards discipline. You don't need dozens of stocks. You don't need perfect timing. You need clarity, structure, and patience. And now you have all 3.